This is exactly what I was worried about. Remember I said to you yesterday when we left off, I said, if we reject from this level over here, then this could be a bear flag. Now, if this is a bear flag, as I said to you before, either we're going to go back down to here and mess around in the 67, 68 level, or we could actually break down and go lower. We could go back down to $40,000. Let's look at why this happened yesterday. I think the first reason what happened yesterday was the FOMC and Trump and Powell literally standing up there and saying, we just don't know. We just don't know. We just don't know. And that's not something that people want to hear from the people setting the interest rate policies. That's probably the worst set of words that could happen. And so now when you look at the rate cuts, the first rate cut is actually scheduled or anticipated. Get this. This is going to be crazy. Well, look at it now, because I want to make sure it didn't move. Next year, July. Next year, September. Next year, September is going to be the first rate cut after the FOMC yesterday. By the way, I think this is completely wrong, and we'll talk about that today. The other reason why the markets have gone down is because there's been a massive escalation in the Middle East. And to be honest, it feels like the US is really, really, really not in control of the war. And that's what we're going to be talking about today. We have a big show today because it's not only me. I've got my friend Henrik here with me today. Going to have a massive, massive, massive show. Let's get the show on the road, guys. A part of me is happy because I was right, and a part of me is happy because I was right. Now the Bitcoin price is going down, and we've given back a lot of that momentum that we had. And now the big question is whether this bear flag actually plays out, and we actually break below this level over here. And then you see that the problem is that can take us like all the way down to these levels over here, or whether we carry on in this triangle and then basically go up again and basically attack that. That will all be revealed today on the show with Henrik. Guys, just before we start the show, remember that these shows, the banter shows, are actually brought to you by NordVPN. Now, I know a lot of you don't really know what a VPN is, so I'm quickly going to demo what a VPN is, because I think now is an important time as ever to understand how VPN works. That's a VPN, right? Now, you all know that I'm in South Africa, and it knows that I'm in South Africa as well. But if I wanted to be somewhere else, or pretend that I was somewhere else, so that my government or that hackers wouldn't know where I am, I could mask my IP address. And what I could do is just pretend that I'm in Portugal. So I'm not going to do it, because if I do it, it'll disconnect us. But if I double click that, then everybody will think I'm in Portugal. Hackers, subscription services. So like sometimes when you want to watch the Formula 1 and the Formula 1 is not available in your country or whatever else, you can just click on whichever country it is, and then the browser thinks that you're part of that country. Netflix, using DeFi protocols, using exchanges, just use a VPN. And Nord is one of the only VPNs that has this double VPN. So it's a VPN on top of a VPN, which means they can never, ever, ever unencode it. If you want to protect yourself, there is a special offer for Banter users. The offer is, I think, like $3 a month. So you need to go to this link over here. There's a link at the bottom of the show over here. Just click that link over there, and that will take you to the exclusive offer. I really think that if you're in crypto, you must have a VPN. Let's just quickly check what that deal is. That deal is $3 a month. If you're still here, $3 a month to protect your cash. Let's do it. All right, let's get into the meat and potatoes of the show today. And because there are so many things going on today, I thought instead of trying to decode this myself, let me try and decode it with someone who I haven't spoken to in quite a while. But I really wanted to speak to him now, and that's Henrik. Henrik, the reason why I say I really wanted to speak to you now is because, number one, we had the FOMC last night. And I know we were scheduled to actually meet yesterday, and I said, hold on. I actually want to meet you after the FOMC, because I knew that you're going to have very sharp words around the FOMC. But also because it feels to me like that the world is in disarray. You've got the war going on at the moment. I made a video which I'm going to drop later today on the other channel, but basically that video says that every single time that the price of oil has spiked, risk has collapsed. Every single time that the price of oil has spiked, risk has collapsed, except for the times when it's not because of a war or geopolitical tension. In other words, sometimes the price of oil spikes when you get excess demand. And in those cases, obviously, markets go up. But at the same time, it feels like Trump isn't in control of this war anymore. I mean, here he's talking about potentially abandoning the Strait of Hormuz. Here he is distancing himself from the strikes that Israel did on the South Pass gas fields, which are the biggest gas fields in Iran. And that really was seen as an escalation of the war. So this war that was supposed to be a very quick war and was supposed to be a weekend invasion in and out seems to be going much longer. I know from my analysis and the video that I dropped on Crypto Insider when I was doing the research that the longer wars go, the longer oil stays, the higher oil stays for longer, the higher inflation, that inflation creeps into the economy. The Fed then say, hold on a second. If there is inflation, the only thing we can do is try and slow down the economy, even though that inflation wasn't caused by excess demand. And that's what they do. That's what 𝗏𝗏𝗃𝗏 did famously in the 70s. But at the same time, around all of this, you're bullish, bro. You posted the other day and you said, I'm going long NASDAQ. I need to hear this.
Maybe a little too early though. Yes. Yeah, because I mean, as I see it, of course, there are many reasons for that. And I think, in general, just to say that the fat lady hasn't been singing just yet, as I see it, you can say that all these factors that we have right now is generating the sentiment that is, exactly the kind of sentiment, the bearish sentiment, where all the bad things have been discounted into the price. So the real question is, are we at a point where we are, where the big top is in, which I think will be soon, or we will see it at some point at least, let's say it like that. And at this point here, we just have all this, all the negative sentiment coming in. So there are many, many reasons why. So if you look to the real economy, you don't see that it's really rolling over at this point. You look to initial claims, you can look at, you look to short-term yields also, that they are not really declining to the degree we need to see if things were really bad. So even though you can say I'm calling for this, sugar high top, it's been a long while since, we've seen this, we've seen this correction going on since October now. And I still see that we're going to have one more blow, higher in a strong move, technically, but also I can say also fundamentally, it doesn't look like this is the top as I see it.
So when you say it doesn't look like this is the top, this is that S&P chart with that famous channel that the S&P's been tracking. That to me looks like the top of a channel, and it looks like we're now about 5 or 6% down from the top of that channel. When you say a blow off top, like where do you see us breaking completely out of this channel, maybe into like a new channel?
Yeah, but first of all, if you put the top line, your trend line there, and you just add it to the bottom, also the top you had done. You've missed it out, you just pulled it out of the page there. But yes. If you actually add it on that top, it can actually have what is called a broadening diagonal. Okay. And that could actually suggest that there could be a higher level. And if you look to Fibonacci levels, that these are not the levels that, there is another level higher coming. And also when you look to early wave count, there seems to be another wave coming. And if you look to another thing also, Rand, that if you look to the equity, to the indices around the world, you have seen that indices in Sweden and emerging markets, in the 𝗏𝗏𝗃𝗏 and the Korea and so on and so forth, they have all made new highs in 2026. I just don't see how you would see that the NASDAQ, for instance, which is have all the strongest stocks in the world, that has been topping out before all of the rest. I made that same argument in April of last year, where everybody was talking about how it had been topping out in October of 24. And I put up the same thing. I said, no, this is not it, because the situation is you don't see the NASDAQ as the first man to fall. It is rather the last man to fall. So I think what you've seen there is one thing, that the rest of the world have seen fantastic moves. Even the Brazilian index, I don't know how the South African index have been looking, but
very good.
We've seen. Okay, there you go. So you just have to think, are we really seeing a world where the NASDAQ is the first man to fall? And if you look to all the fundamentals and all the things that we are then calling it a top right here, just because it hits somewhat of a line, which I actually have to say that I think it's a broadening top, broadening diagonal. So it's I think there's one more go to this, and I think actually the NASDAQ and also the S&P looks quite bullish in that structure that they are putting up right now, and we're going to have an amazing rally also into a recession, which I think we are closing in, and we're very, very close to, and we can jump into that, but when we see that a global recession setting off, you normally see also how capital rotates into the US at the final phase of that, and we're not really there yet. So I think we've got a couple of months more, and this can develop into something of a really, really powerful move. Remember 2007, we had the same situation. All the fear was out in August of 2007. And then we saw a 11 weeks strong rally in the NASDAQ, which brought the NASDAQ from up by 25% in the matter of 11 weeks. I think we're going to see something similar.
Okay, so, how does the war and what's going on in the war affect your thesis? So in other words, does your thesis only work if there's a short war, if the US ends this thing in Iran, or does your thesis also hold if oil remains higher for longer? Because I don't know, or I don't see a world where risk markets continue to rally against oil higher for longer. If we get an oil price of 130, 140, and that continues for a couple of months, and that starts flowing into the inflation data, and people start thinking, well, I think both you and I know what happens with the Fed, right? The problem is that prices go up, but prices don't go up because there's a lot of demand or because the economy is overheated. Prices go up because one of the input costs, the main input cost, is higher, and as a result of that, inflation gets higher. And then what they say is, well, let's put the handbrake on the economy to cut this inflation. At the same time, that lands up causing a recession. So I know you're expecting a blow off top. I just, from a market sentiment perspective, I don't see how we get that blow off top against a background where the world is in disarray like this.
I mean, the economy is a dynamic factor, dynamic, species here. I mean, when there's something happening, like when you see prices going up on oil, there's supply right now working out there. There are people thinking, oh, this is fantastic. Let's drill more. Let's try to see if we can get supply, routed somewhere around this. This is what you see always. I mean, it's not a static world. It's not like we're just saying, oh, we need to get it through the Hormuz, otherwise it's not going to. There will be other ways of being, seeing the oil starting to flow again, because everybody also all countries know that we got to get oil flowing, otherwise it's going to be a problem. So just looking to this and saying this is just it, and this, if it doesn't get resolved, it's not going to be it's going to be a problem. I agree with you, obviously, that if oil is staying up high for longer, you're going to see that is putting a downward pressure on the economy. But I will also say, I don't think the whole correction we see right now is because of the war. I mean, everybody is so busy saying that. I mean, it's because we like these simple explanations to things and say this is the one reason and this is the only reason why we are seeing the development that we do. We have to understand that we have seen a fantastic rally since April of last year. I mean, I think in 𝗏𝗃𝗃 it's up 170% or something
Crazy.
like that. And we see, I mean, exactly. So wouldn't we expect that we see some kind of pullbacks and some kind of corrections? The answer is yes. So I think that these kind of moves here, they will require that there are some kind of a consolidation at some point. And so I'm not too concerned about this current one. I'm more like what comes after this. Yes, the world is worried about this, but it's a dynamic, world, and you're going to see that supply will find its way around. And if you look to previous wars, as you also talked about, you'll actually see that had the first and the second Gulf War. We didn't see these it was like the market collapse there. It was like we saw a big market top. We like to talk about these things like geopolitically, this is the only thing that matters. We have that all the time. Last year was tariffs. It's the only thing that matters. And we just talk about this, and that's how we kind of like to understand things. But the thing is,
the markets are more dynamic.
Right
the markets are more dynamic. Yeah.
Exactly, and the same as goes for the economy. And at this point here, I'm far more concerned about what we see in the slow deterioration. I mean, I even said something in your intro that I couldn't agree more to. That that the guy there, Powell sends and says, we don't know, and I'm like, wow, unbelievable. Look to some of the most simple things that you can look to: the creation of jobs and the duration of unemployment and so on and so forth. And if you look to those things, these are actually showing us something that is really bad. And
I have to play this.
Sorry.
I have to play this if you don't mind. I have to just play
bigger. They could be smaller. They could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. To your point.
This is a Fed official talking about the dot plot. He says people are writing down something that they have no conviction in because they have to write something on I have to play this again now that the viewers have context. This is Powell talking about how the Fed officials completed the dot plot yesterday.
Bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. To your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on.
I get the fact that there's an uncertain future, but I think as the Fed chair, you've got to say, look, not we don't know. We've modeled various different scenarios. We've attached probabilities to the scenarios, and based on our best analytics. I know you tweeted.
That is communication. That's what you talked about there. Is the communicative part of it. So how you communicate to the public about this. This was terrible. I mean, I think any communication expert will tell us the same. I mean, you're just basically telling us that the dot plot, you can take that and you throw it over the, your left or right shoulder and say this is worth nothing because they're just doing it out of, we have to plot something. I'm happy you brought this up because I saw it yesterday and I was, sitting with and I was like just shouting out, what the F? I mean, is he talking about? Are they just doing this for, like they don't know? And that's what I say also, Rand. I think if you look to a few simple things, and this is what I think sometimes people that are very much in going into depth with things, they are overthinking. That's a very common thing to do for human nature, and the more you're an expert within a field, you overthink things. And if you look into the simple things, the simple indicators of where the economy is heading, that is giving you the most clear outline of the outlook that you can have. And that's why I'm happy you showed this, because it actually shows us that there's no adult in the Fed at this point.
So you said that the Fed is first of all, I was scared to bring this up with you because I knew that you're very emotional about the Fed. You are claiming that they're the furthest behind the curve that they've ever been. Tell me why you think that, and I want to test you a little bit about something else. But first, just tell me why you think that they're so far behind the curve. Because as Powell did say yesterday, he said, look, number one, the unemployment rate remains stable, and inflation is, around the 2.5%. It goes up or down, but let's just call it for now 2.5%. Their target's 2%. Seems like they're in the sweet spot. Why do you think that they're so far behind the curve?
They have two mandates, and they need to understand when to shift the balance from the one to the other.
Yeah.
And if they look to history, what they have done before in terms of when they started to focus away from inflation and to the labor market, they have been late. And I have a few charts I can just give you if you want to just, if that's okay, we can take a look at that.
Let's put your screen on. Let's just hold on a second. Let me just see if I can get.
I'll switch it over.
Okay. Yeah. Okay. Let's go. If you can just switch to Henrik's screen, if you can. There we go. Yeah, here's your screen coming up. But you got more windows open on your desktop than I have, that's for sure.
Yeah, hang on, I'm sure you're editing this out, right? Hang on, come on, there we are. I need to say, there we go.
Okay.
So, all right. So when I say that they are further behind the curve than they went been, in history, that I look to the one thing that is important for an economy, that is the ability to create jobs. And if you look to the non-farm payrolls and you don't look at it on he was talking about, you have to look to 1 month, that was great, and then the other one was not so great. And, but if you look at it on an average, on a moving average, you can clearly see how the business cycle is moving up and down, and so on and so forth. And you don't need to be a genius to look at what we have here. And if you look to the level we have right now in terms of the 12 months moving average, we are now below the levels we had going into a recession all the way back to the 70s.
How much of this is AI, and how much of this is weak economy?
But that doesn't actually matter. That doesn't matter, because AI does not do one thing, which is the main component of the economy, and that is it does not consume. So when you look at the GDP, you have consumption, you have investment, you have public consumption, and you have net export. And what you need to have, 60% of GDP is private consumption. So now you're a business and you are laying people, you want to hire somebody in, and you only hire one person in. That might be good in the long time frame because you become more productive in that business. But in the short time frame, it's not a good thing, because then that person that is not getting hired in is going to not be able to consume the same amount. So when we heard yesterday the Fed talk about how he said the economy is strong.
Yeah.
I mean, this is the worst level we have had, and we have to remember here, these are absolute levels, which means you have comparing 171 million labor market with 150 million labor market here, with a much, much smaller here, and yet this level here is lower at this point. If you look to the and then he talks about unemployment rates. The unemployment rate is connected to what is called labor participation. So when labor participation drops, that means that the denominator is actually dropping. And that is why the labor rate, the unemployment rate is so low. In the span of from November to February here, the labor force lost 1.4 million workers. Of course, you're going to see a lower number on unemployment rate, but that doesn't mean it's good. And if you look when you look at this is one of the most important things for an economy, which is how long are people then away from the job market. This is the unemployment, average weeks of unemployment. Going into the financial crisis, we were down here at 16 weeks. And when you have had bad times there, it was going up into recessions. You see how it goes up every time you get a recession because people are staying unemployed for longer. Then you have the financial crisis. Look at this direction here. We are now 25 weeks, which is 50% higher than going into a recession in the financial crisis. How is this a strong economy?
So let me ask you, I know we touched on it, Henrik. I know we touched on it, but I want to just spend a little bit of time on it because it does worry me quite a bit. Fed's mandate, inflation, and unemployment. I think the one factor that the Fed isn't really looking at is the jobs that are going to be displaced because of AI and are already being displaced because of AI. We've read the headlines, the Block, Dell, and all the big other ones actually cutting jobs. I'm cutting, I use our office as a proxy. I've cut 30% of our office staff because in some shape or form, their roles have been replaced by a Mac Mini for all intents and purposes. So the question then becomes, this is now, what happens in the next 12 months when, 10% of the American white-collar workforce loses their jobs and can't pay their mortgages as a result? How does this play out? Like, do you believe that the Fed can cut their way out of that? I don't believe that the Fed, just like the Fed cannot raise their way out of the inflation caused by oil, the Fed can't cut its way out of the job losses that are caused by AI. And this is the part that's worrying me.
Exactly the right thing there, as I see it as well. First of all, it's not just because of AI. Let's be very, very clear on that. I mean, I'll get back to whether they can cut it or not, but because I agree with you, they cannot. But if you look to just a simple thing here, because we have to understand that this is about the whole economy. This is not just about the labor market. If you look to the whole economy, and one of the biggest components of the economy is the housing market. If you look to how many existing homes sold as a ratio of population, you can see we are now down at very, very low levels, which means that there is no activity in the housing market. That is not a good thing. Normally, into the financial crisis, we were down here, but that was at a time when the unemployment was 10%. Here we were at the same level. That was when unemployment was double the level we have today, and so on and so forth. The level we have right now here tells us that there is no activity, and you're hitting it spot on. You're saying, what happens if this goes up? What happens if we're not going to see the kind of hiring that, which is apparently already dropping a lot, as we can see with the non-farm payrolls? What is then going to happen?
Yeah, maybe let me just elaborate on my concern. So number one, my concern is that the Fed cannot cut rates to get those jobs back, number one. The second part of my concern is that is the American consumer that has a mortgage and that needs to pay the mortgage, right? So, I mean, if you take the Block, and I spent a lot of time researching the Block or Jack Dorsey's company's retrenchments. But the type of people that he retrenched, we basically looked at the type of people that they retrenched, and then we said, how many of these potentially have a mortgage? And like 90% of them potentially had a mortgage, right? Now, what does that do to the economy, to credit markets? Fed cannot cut its way out of it, and you've all of a sudden got the situation where 10% of the white collar workforce disappears. Like, I mean, I can't see, unless AI increases productivity very, very, very quickly, and we get an increase in GDP, which you rightly pointed out is a flawed metric.
Get it? You cannot get it from AI. Let's be clear on that. I mean, people are saying you're going to get it. You cannot get it because if people are not in the current setup in the economy, if people are being laid off, and we don't get the same kind of job creation, the C of the private consumption is going to be lower. When this private consumption is lower, that means that you have lower growth. So you cannot, even though we want to say that we're just going to apply AI and it's going to solve the thing, it cannot. It will actually make the world or the whole situation worse, which is I think is what people kind of forget.
So is that how the blow-off top ends in the massive recession? Is that the driver for the because on paper it's not going to look like a recession because the economy is still going to be productive, etc., but the working force is going to collapse. Now, what 𝗬𝗙𝗫𝗍 said in his Substack is he said something like, in order for the financial system to collapse, you don't need 100% of people to default on their mortgages. You need something like 6% to cause a massive banking collapse.
Now you're looking at a situation where you have a default rate that is already above the level we had going into the financial crisis. So I think we are very, very much there. I mean, again, we have to just look to what the Fed said yesterday. The situation, the economy is not strong at all. I mean, when he said that, it's the resilient and all these things that we normally hear. So that's why, coming back to your initial question, why did you say, Henrik, why did you write that the Fed is the farthest behind as it's ever been? Because I've never seen it so disconnected from the realities of the economy. And the only thing that they seem to sit and talk about there, and also with the journalists, were a whole thing about was this about the war. So yes, to your question also, what is going to make the situation worse going into a recession is going to be the application or the adoption of AI, because that will not help GDP. That will help that the businesses can become more productive. But the situation is you need somebody to stand there in queue and buy the stuff that these businesses are delivering or developing. If you don't, if there's nobody buying your goods, well, you can be as productive as you want. That's again back to supply and demand. Demand needs to be there, because if you're only creating a lot of capacity through extra, AI tools and so on, without abusing so many people, where would the demand come from? And this is what people,
Wow.
I mean, it's not just a supply world, it's a demand world.
I don't usually, when people tell me that there's a recession coming and that, I don't usually take those things too seriously, because I always believe, because I'm an optimist, I always believe that the positive forces will outweigh the negative forces. And so far, for a long time, I've actually been right. But this is the first time I'm actually this is a fundamental change in the world. Now, when there are fundamental changes in the world, the pattern around fundamental change is always the same. And that is that first you get a dip. First you get a dip, a rise, which is the illusion of what this new technology will actually bring. 2001 is a perfect example. Then you have a massive crash while the world realizes that this technology maybe is not as efficient as it could be, but also the implications of what this technology is going to do cause a crash. And in 2001, that crash took 15 years to get the NASDAQ from 2001 to 2015. It took for the NASDAQ to get back to where it was at the top of the 2001 high. And what you're saying correlates back to that. And what that is we'll carry on in this bubble, this AI bubble, for a long time until we realize that AI is going to create output but not demand, and that the demand will get entirely killed, and that's the problem.
Yeah, and then you have a second factor, which was what I tried to show with the housing market, because in 2001 it was a mild recession. It was mild because the housing market was not affected. In 2000, if you look to history and you go through recessions, you'll see that the severe recessions are always the ones where both your balance side and your income, your P&L side, as a person, right? My job, my income, and my costs, that's one thing. And the other thing is my house also. If both are affected, which is in the severe recession, like in the financial crisis, those are the severe ones. The problem this time is that you have 2001, as you just put out, but you also have 2008. And that's the problem. You have both of these this time, because the housing, as I just showed you, people cannot afford moving into a new house because they cannot let go of the current mortgage loan that they have. So you have a double whammy this time, and by the way, the debt is much, much higher, and you have a potentially inflationary development down beneath.
The debt is much higher than it was in 2008.
Much higher.
Much higher.
And we talked about. So
I think it's like 8 times higher or something. I think there's a multiple. It's like 8 times higher. Obviously, it's not on an inflation adjusted basis. But I think I think I saw the other day that it's something like 8 times higher.
Obviously, yes, and there would also be something we don't know so much about, which is the private credit, which I also found peculiar. Nobody talked about yesterday.
Let's talk about private credit, because that's another alarm bell that you have been raising. And again, I just want to just remind viewers that we are talking a little bit about doom and gloom, but net. Henrik said he's actually bought the Nasdaq. He actually bought the Nasdaq last week. He says it was maybe a bit early. So first up, then down. We're talking about the down part of it. Tell me about this concern around private credit. Where does this stem from? I know yesterday, whilst the FOMC was going, you were like, no one's asked about private credit. Is anyone going to ask about private credit? And then you spoke. You said the credit crisis moves in the dark. Private credit crisis is a new subprime. It's contained until it's no longer contained. Walk me through what you're thinking here.
Everybody needs to somehow to have, to buy a new car, to buy a home and so on, to buy a business. If you're another business, you want to, acquire a business, or you want to invest and so on. So you go out, you try to find credit. If you have money, it's easy to borrow money. If you don't have money, it's more difficult. Back in the days in 2007, we could go through our mortgage loan because, the housing market never drops. So that was kind of a, ATM. People could go and just point to their house and say, this house here is going to rise by 10%. Hey, I want to, take out a mortgage loan. And then you had people that should never ever have had money, because when money is plentiful for the suppliers of money, whoever have it, the mortgage lenders and so on, then you would see that they will try to go to certain lengths because everybody has a budget that they need to reach. So the salesmen say, yeah, can we go with this one? Yeah, let's go, and you push it on a daily basis. So we got into the situation back then when we had all these ninja loans, also no income, no jobs, and they were still, giving them loans because the housing market, who could see that we could have a drop on that on a national basis.
The ninja.
Yeah, but that was what it was called. And then you had now fast forward to 2026, because obviously back then we had the whole regulation. We cannot have the banks there running around like crazy salespeople, and just supplying loans to everybody. But the problem is when you have these low yield, low rate environments, so for many years, which they kept after the financial crisis, what happens is with people with money, they need to have a return. So what they do is that they go to their private equity fund. They go to, somewhere else with this money. This money is like, an organism trying, going around the banks, because the banks is not going to supply these loans. Then you've had car dealerships and so on starting to, to lend out money also. So the money, the credit that has been supplied out to the public is now bigger and, wider and more opaquely spread out than what we saw into 2007, where it was mostly around the housing market. Today, it's about a lot of things, because there have been people out there asking for credit, and if they want to give us a 15%, on the money that they loan, then who does not supply that? Because in the bigger scheme of things, we might lose money on one guy, but then we're going to have the other one. So this is the way that money works. This is the way credit works. It has now been morphing outside of the banks and into a lot of institutions that are not banks as such. They have been supplying money to private equity funds, and private equity funds are then going out and been spending and investing in businesses. This is a true fact. Most of the portfolios of private equities are vastly overvalued compared to the real value and to the cash flow. So you have businesses, you have private people, you have all these that have been obtaining loans through what you can call the dark, in the dark, so to speak, not on the balance sheets of the bank today. That's why the banks, they look quite okay, because they have large institutions. So the problem is still that when Mrs. Johnson is starting to loses her job, or has problems in paying her bills, well, then she will default on that loan. And when that starts to grow, which is what we see right now, that's where I said the default rates on certain kind of loans is actually higher than going into 2007 and 8. Well, then you're going to have a bigger problem. And it's just about how big that snowball is going to be. At some point, the different institutions there, they start to look at each other and say, what about this credit line I have here? Do I need to pull that? And do I need to pull that? We're starting to see that. Last week, we saw a lot of these things actually starting to develop. So this is the problem in the system, is that we have a similar situation like in 2007. It's not the same. It never is the same, because we have the legislation. It's similar, and that's the problem right now. We are seeing the weakness in the consumer is playing into the credit institutions, whatever they are, wherever they are, and that's why I said I called it in the dark, because the dominoes are lined up. We don't know which dominoes are going to drop. We don't know which ones they're going to hit that can, flip the next and the bigger one. And if you saw Deutsche Bank last week, they went out and said, "Oh, we know we have $30 billion in worth of exposure to private credits."
JP Morgan came out as well. JP Morgan also came out and they raised an alarm bell as well. So on the back of this, you're still bullish. You're bullish. You're bullish S&P. Tell me about Bitcoin and ETH. I want to bring this back a little bit into crypto. Tell me about your views around Bitcoin and ETH. I think I read somewhere that you were still bullish. I think you were buying ETH or bullish ETH, which means that I take it if you're buying ETH or bullish ETH that you are also bullish Bitcoin. What's your thesis around Bitcoin at the moment? Like 4-year cycle going down to 40,000, or do you think it's recovering?
I never actually understood this with the 4-year cycle and so on. I know that's what people are talking about. That's like with the M2.
Me neither.
That was the whole
me neither. But when it crashes on the 10th, when it crashes on 10:10, and the 4-year cycle was supposed to end on 6:10, and 6:10 was the high, you got to pay attention.
Yeah, sure. But again, it would be fantastic if we could just explain the world by 4-year cycles and everything. So I think there's there's kind of a self-fulfilling kind of prophecy to it, and I don't know. But what we look at is that when I see Bitcoin and Ethereum, but especially Bitcoin, as the ultimate risk asset, you can say that what it needs is that it needs an economy that is okay, and it needs still where also the stock market is okay and strong, and it needs that there is new fresh liquidity coming into it. If you have those factors in, then you have a good opportunity to see Bitcoin and Ethereum and crypto in general do okay and do well. I think for a little while here we have seen that the correction in the stock market has been, being standing a little away for Bitcoin to be able to move higher. Mm-hmm. But I think that the situation that we talked about here, and again, I am surprised to see that the Fed is doing what they said yesterday. But I still think that when shit comes to shove at some point, or when the shit is hitting the fan, you're going to see that there will be this understanding that more liquidity will be needed and needed fast. And it may be something of more of a shock. It may be that it's we need to see institution having problems or something like that. But they're going to try to do it, and they will. It can also be. I don't know what's going to be the reason. In 2007, as I said before, we had that fantastic 25% move in the Nasdaq, which came after the Fed actually started to pay attention to the system, to the situation, and then the anticipation of rate cuts sent the market higher. That was from August and into October, and actually the rate cut did come, but it came in September. So it was 1 month after we saw the real strong rally in the Nasdaq beginning. I think maybe I'm starting to think that it could be the new Fed chair that comes in May potentially. That could be the reason why the market say, "Oh, he's going to come in and do something seriously about the rate cuts." So that could be the anticipation of this. Because it is needed. I will not make no mistakes. It's absolutely needed at this point with this kind of economy that we have now. As I said, the Fed is so far behind, and it might be that the market will have to look for the next Fed chair to actually start to anticipate the inflow of liquidity.
If you were the next Fed chair, and he's coming in, he's got Powell's got one more meeting after yesterday. What's your first move? What, you walk in there and you slash interest rates by 1 percentage point, or what's your by 100 bips, or what's your move? Chairperson Henrik.
I'm not that clever. I think I don't know which level. I don't pay attention to that. What I think is that we have seen if you look to the consumer, you look to the labor market, you look to everything, you look to the housing market, it's in the gutter. So are you really so certain? I would ask one thing, and I would ask the people in there to say, show me why the economy is strong. And show me why we think that it doesn't need any kind of support at this point here. Because as I see it, we are rolling over. And then I will have somebody probably to calculate how much is needed and what is not needed. Because we also need to understand that there is a lag to this. And the more, physicists can tell us more about that, the more momentum something gets, large body like the economy, the more force is needed eventually to stop it going in a certain direction. And I think we are at the point here where this is going to accelerate, and with all, as you said, all the uncertainties in the world, with oil coming up being a deflationary factor. Remember, when oil goes up, everything, people have to cut spending on something else. That is not good for the economy. So this is not I don't know what the Fed is doing. So I don't know how much I would be cutting, but I would be asking for the evidence of a stronger economy and why we are so afraid of the running hot scenario, because that is definitely not what I see right now.
Agree. Henrik, my friend, we're out of time. That was amazing. I'm glad I got all those points. Really, really good. Very good to see you again. And I'm glad we delayed it to do it after FOMC, because I think we got a lot of juice just from what came out last night, my friend. Guys, if you want to follow Henrik, all his socials, all his links to his newsletters and whatever else, all in the description. Otherwise, we'll see you guys again tomorrow. Until then, trade well, my friends.